Hello everybody, it's me the Boss Hog. I thought I'd go with a slightly different thumbnail and introduction this week, trying to make my videos a bit more professional and a bit more valuable. Welcome feedback, but anyway, standard format otherwise, let's do it. Alright, so overall pretty great week, up just over 3,000. I did start a bit rough and I was thinking to myself, well, this is what I get for calling the end of the bear market last week. However, from Wednesday it got a lot better, a bit of stabilization on Thursday. And then Friday really finished strong, especially on the US side of things. All but one of my larger positions was up. Two of them were influenced by what I would class as decent earnings, and two of them, but they overlap. So one of the same stocks with the decent earnings and one different stock saw double-digit percentage gains. And again, these are my larger positions. I'm quite top-heavy, so that can make quite a big difference overall. We added 1.6k this week, putting us back to 10 days ahead of schedule. Just as a reminder for anyone new, the plan is to basically top up my ISA and my wife's ISA, which is £40,000 by the end of March. So basically this tax year, or slightly into April technically. So at the moment we're running 10 days ahead of schedule, which is great. Finally, my pet insurance money came in, so that's it took about 3 months actually end to end, so that was 1.4k, and we basically used that to put this into stocks. That feels really good. I am still expecting some remortgage money to come in, hopefully next week. Most of that has already got a home, basically paying off a debt, but a little bit of it is going towards stocks, so should be able to get further ahead as well is the plan there. But felt good to put in 1.6k. Most of it, as you'll see shortly, was just building on our ETF positions. I am going to talk about one of the ETFs in detail, same as I did last week. So hopefully, again, that's interesting. And to be honest with you, the ETF I'm going to speak about today is more in my area of interest. It's more value, and I think it's probably, I can imagine myself adding quite substantially to it over time. So I'm quite excited to do that. This month, as I've touched on already, is very small for dividends, just the way it falls basically. I've got a very good month last month and had a couple of good months prior to this one, but for whatever reason this one is quite low. We did have a 144 from Apple, and again, as you'll see in just a second, it just went straight back into Apple, so not much more than that. It's like I say, very small on the dividends month, but let's just confirm what I bought before we have a look at Disney and other earnings as well. All right, so I don't want to labour these points too much. It's basically the same as I said last week. We've now got our 8 new ETFs up to £400 each, so great. And again, the plan is here basically they'll average out to about £100 a week, but because I'm depositing every fortnight, it tends to be 200. So we're going to talk about the VanEck Global Mining in just a second. The only other addition here in terms of what I've been buying is Apple, and that was just simply the dividend reinvestment from that. So I would say Apple at the moment is not so far off its all-time highs. I'm amazed, honestly, at how well Apple sales are holding up. I think it's a combination of basically being a consumer discretionary brand almost, as well as a tech company, and also something that continues to go under the radar is the fact that they're making many billions from their services revenue. Like they're gradually turning themselves into potentially like a rental ecosystem. I think it's an incredible company, to be honest. So even though I'm buying near all-time highs, it doesn't feel terrible. It's such a small amount anyway. I don't think it's going to make too much difference in the scheme of things. So I don't want to spend too much time on my buys this week. I did no selling this week, which is hopefully going to be my plan for the foreseeable future. So we can get straight on to looking at my portfolio in a bit more detail before we look at some earnings. All right, so this is my portfolio update from ending the 12th of August. You can see my week-on-week change there, and which is how I've ordered it. Most of my larger positions had very good weeks. The one exception would be Games Workshop. Again, I continue to think that's undervalued. It had a little spurt from its sort of £60 lows. It's now back to 75. But for me, as I've touched on beforehand, I think that stock should be valued about £112. So we're more than happy holding it, even though it had a poor week. Everything else was very positive. So I'll start with Genius, even though I haven't got much to share at the moment. Similar to last week, it just seems to have run up on a combination of kind of more risk in the market, plus Sports Radar, one of probably its main direct competitor, had pretty solid results. Its earnings are on Tuesday, so we may well face reality and see a significant drop, or indeed a significant rise next week. But at the moment, we've got nothing to bring you. I do plan on delving into the numbers once they present. And GAMA, likewise, no new news. They had a very reassuring half-year update. Basically said that earnings are going to be on the upper end of expectations, which aligns with my expectation. So that was really good, and they continue to just drift up as my largest position. So The ones I do want to talk about today is Disney. So I've now been on the earnings call. There are one or two concerns I would raise that I think have been sort of glossed over by the market that we'll get to very shortly. But broadly speaking, it was a great set of results. Like I've really kind of oscillated this year between having nervousness about Disney to feeling really confident about it. In Q1, EPS earnings against expectations really smashed. Q2, I would say I was quite disappointed. Q3, earnings definitely under still some pressure, but the subscriber numbers are looking really good. Or to be more accurate, the subscription numbers are looking really good. So again, we'll delve into that in just a second. But I think the 13% run up there was nice. So that's great to see. I do want to talk about GDIG. I love the ticker symbol. I wish in a way it was just focused on gold mining, because then it could be Gold Digger as an ETF. But I'm a bit of a sucker for all the tickers that are great. This one is world mining, so it's not just gold, it's got everything. And again, to me, it's a really interesting ETF. It does focus on large companies, but it does have a very long tail in terms of some of the more interesting, exploratory, some of the more exotic resources, etc. And it's cheap, which I tend to prefer. I won't spend too much time on Legal & General, but I do just want to touch on the results. They were rewarded this week with a 5% increase. I mean, it was a friendly market, to be fair. Legal & General, I have made the point before, and I think I'm increasingly of the opinion that if you could only hold one FTSE 100 stock for the rest of your life, or for the next 10 years, Legal & General should probably be in that conversation. It is diverse, reliable, consistent, profitable, efficient. It rarely surprises, and when it does surprise, it tends to be to the good side. Asset under management was a bit under pressure for sure. We were seeing sort of 12% drops there. However, I would point out that in the market, that's not a huge surprise. And if you compare it to T Rowe as an example, they were seeing 20% drops in asset under management. So broadly speaking, I would say, as my kind of proxy in the Americas for LGEN, it's a pretty good comparison, and everything else was basically pleasing across the board. Particularly their retail sales were very strong. So again, it continues to be very profitable, and I just think it's a great place to put your money. It also yields over 7%, which is great. And again, I would say it's more modestly undervalued after the run up, maybe sort of 5 to 10% undervalued. But again, when you've got a yield of 7%. To me, that looks really great. So just wanted to call it out. I did also want to talk about Kingfisher, basically flat for me week on week. A lot of the consumer discretionary stocks that are sort of DIY or hardware focused got knocked during the week. There was a couple of analyst downgrades, basically. They put Kingfisher down at 230 pence from 250 on the argument that the competitors are really struggling. There isn't really a catalyst for change. It's likely to see, difficult trading. They did caveat it with the fact that Kingfisher specifically, and they did, by the way, put red against many other companies, but Kingfisher was the one that I have. They did highlight for Kingfisher specifically that there's an attractive turnaround story. And to be honest with you, that's really why I'm in Kingfisher. It's a bit safer than that, it's profitable, it's everything else, but it kind of lost its way as it expanded primarily into mainland Europe, France and Poland, as well as the UK. But actually, I would say over the last year, it's really improved itself, and it's no longer kind of an unwieldy basket case. And I think actually the downgrade's a bit harsh. I expect it to perform better than its competitors. It also has a much higher trade percentage. So it's kind of similar to sort of Home Depot in the US compared to the likes of Lowe's. And Lowe's is more like Wix in terms of its more consumer driven rather than business. So I also expect that to kind of help it hold up as well. Ultimately, though, I have no worries at all about Kingfisher. I just thought it was worth calling out because a few people I know have this stock. And for me, I'm still very comfortable with it. I'm up very fractionally. I have a 248, I think, average, and it's trading in the low 2.5s at the moment. I will be getting a dividend for this relatively shortly. But yeah, I'm fine with it. It's not a huge position for me either, but even if it was, I wouldn't have any concerns about it. It is what it is. Ultimately, it's not the best business you've ever seen, but it's dirt cheap. It's improving all the time, and I think the downgrade's a little bit harsh considering it's hardly expensive at the moment. So the stock did hold up relatively well, even in the light of the downgrade, whereas some of the others highlighted got a lot more beaten up. But again, I just thought that was worth highlighting as well. So those are the summaries of my portfolio here. If I haven't spoken about any company, as always, feel free to ask. But without further ado, let's have a look at both our GDIG ETF as well as Disney. Talk about them in a bit more detail now. All right, so first up, I just want to talk about the numbers here very briefly, especially if I think about the ETF I looked at last week, which was WCOS, which was a consumer staple ETF. First of all, this is larger, but not huge, $274 million market cap. It's broader in terms of its holdings. Last week we were looking at just over 100 holdings in the WCOS. This has got 163. But interestingly, the top 20 here only accounts for 62%. Against WCOS, it was 68. So it was, again, slightly more top heavy, but not by a huge difference. But to me, yeah, the big difference here is the length of the tail. Like, there is a lot of very small holdings, and even top 20 here is barely over 1%. So it's again, like, it's very extremely well diversified. For me as well, the country diversification is really great. They're massively overweight compared to sort of their comparable index. In Australia, like if you look at the index, this is just over 20%. Like, Australia is very heavy on the mining, of course. But for me, this is great because I have almost no exposure to Australia. I do like the kind of mining and the income plays more generally down in Australia. I think, it's a nice stable country. Shouldn't go too wild, and for me, like, I actually did get quite into looking at miners last year, but I got heavily stung and impacted by the fact I have 2 Russian focused minuses in my portfolio, still sitting on very large unrealized losses for those in Evraz and Polymetal. So for me, like, I know I like the sector, I do want to get back into it, and the thing I like about this particular ETF is the fact that, if you look at the top 20, most of these, although not all of them, are quite well known, I would say. You've got your BHP, your Rios, your Glencore, your Vales, Anglo-American Glencores around here as well. So yeah, we've got a lot of larger companies. But again, if you were to look on this ETF, it gets extremely exotic very quickly in terms of companies you've never heard of. Again, and different stage miners as well. Like, some of them are quite exploratory. Others, are very well established and already have viable working mines. So I kind of like the fact that it gives me very broad diversification. The one thing that was annoying that I really tried to find just about everywhere, looked at Morningstar, looked at Vanek themselves, who do this ETF, tried to Google. I cannot for the life of me find a resource allocation. Like, it would have been great for me to see, 10% gold, 12% nickel, 5% silver, etc. Could not find that anywhere, and for me that feels really weird to not have it. So if anyone does happen to know where I can find that resource, great. But the breakdown when you export it just doesn't have that level of detail, which for me is a bit unfortunate. Yeah, so sorry about that. I wish I had it myself to share. I will just add as well, like, when we were looking at the PE for the WCOS last week, the consumer staple, that was trading at 20. I think we all agreed it was relatively expensive, although a safe haven in the current market probably feels pretty good. This PE, I would say, is really cheap, especially considering the performance here. It's a relatively young ETF. But if you look at annualized, it's a smidge under 14%. Total since inception is a smidge under 50%. But the year to date is a little bit rough. Again, I think there are fairly obvious reasons for that. And broadly speaking, like, they themselves are advising that it might not be suitable for people who are what they class as short-term investors, so less than 5 years. For me, again, I really like this ETF. I imagine that even once I get to £2,000, which is the plan for these 8 ETFs, I'm probably going to continue buying. Again, I want to have exposure to commodities, good inflation hedges. I get there's a cycle in these things, but honestly, I don't really care. I'm investing for over 2 decades. I'm not really a short-term investor in these type of things. I would say the expense ratio, I wanted my expense ratios for these ETFs to be no more than 0.5%. So this is on that edge. I do have 1 or 2 that are over that, by the way, but that was my focus. This is managed. So, okay, fine. It rebalances every quarter as well, so also fine. And to be fair, like I say, the performance here is perfectly fine. The weighted dividend yield at 5.81% is very eyebrow raising, I would say. Obviously, some of these at the moment are like at the peak of their commodities or have recently been. So I almost expect this yield to come down. The ETF itself doesn't pay out the dividend; it just reinvests it in itself, which again for me is fine. I'm not an income investor at this time, so again, perfectly not a problem for me. Morningstar rates this as 4-star, listed as large value, so basically in its top left quadrant, so it's value as well as large. And actually, if you look at the breakdown of this again, because it's so heavily weighted toward these monsters at the top, it's large cap in terms of large cap in terms of its overall market cap is sort of in the 80%. So it is very much like large. Morningstar actually has an additional categorization for like huge. The ETF itself just groups them both together, so slightly different there. But broadly speaking, I think large value is an accurate description. A lot of these shares aren't trading on huge multiples. Interestingly, some of the more exploratory ones are, if they've got a lithium exposure or things like that, then that tends to be a driver to an expensive stock. But again, a lot of those aren't huge holdings, so it doesn't really change the impact of the ETF. So like I say, I expect this in terms of its performance over the next few years to be quite uneven, and you can even see the 4 years to date has been quite uneven. So you need to kind of buckle in for this and be prepared for some variance. But again, for me, it looks really good. I think for me, my plan will be to get to again about £2,000 for this holding, and then any time I can sort of add to it on when it's either red or flat, I will take that opportunity to do so, and probably sort of aim to get to about 5% of my portfolio. To me, feels like a good kind of hedge. But a good holding for a diversified mining setup, which again gives me significant geographic exposure to many places where I'm not exposed at the moment. Right, I was talking about Canada last week, okay, so this is going to help with that. US even isn't particularly huge in this. South Africa, I have virtually no exposure. Brazil, similarly. China, okay, lots of things are dependent on China in one way or another, but again, it feels pretty good to get some of these some of this exposure, as well as even to some African countries as well, come together to form a few percent as well, where again I haven't got particularly large holding, and I would actually like to have an African ETF, but there isn't one in my brokerage at the moment, so a bit of a shame. So maybe this is again a similar proxy on that. So and for me, I don't have a plan to have an Australian ETF in the same way I have a Canadian ETF. So for me, this is again sort of a bit of a proxy play on that and to fill in for that gap. So I'm very happy with this. Actually, I like this a lot when I started to look into it in detail. Obviously, let me know your opinion. I'm still very new to ETF investing, but yeah, I actually prefer this one quite a lot to the W cost at the moment, which is I'm mainly just doing and grinning and bearing it to get some diversity. Whereas this, not only does it give me diversity, I actually like it, and I think it's affordable. And as long as you're prepared to ride out a bit of variance, I think you get a very nicely balanced ETF in this one. So yeah, I'll put the ticker there. Let me know if anyone has any thoughts, or you've got it, or etc. But yeah, that's my thoughts on that. Let's look at Disney. All right, so in terms of Disney, I went on the earnings call, and this was the description that Bob, the CEO, said, and it really resonated with me. Disney is a synergy machine, and I was like, do you know what? That's kind of exactly why I'm in Disney. I have a medium to large size position in terms of my portfolio. I've got 30 shares, and I've kind of, like I added earlier, I've sort of been on the fence about what I think of this company in terms of how it's coming out of COVID and how it's recovering. And broadly speaking, Q3 was extremely good, I would say. The most impressive part to me was, I've just called it parks here in the table, but basically it's parks, entertainment, cruise ships, etc. Not only did that grow by 70% in terms of revenue, I think their expectation for how they were growing it was also impressive. So per capita spending was, again, to me, one of the highlights within the highlights, was up 30% against 2019, so basically pre-COVID levels. Attendance is still slightly down, although certain places like Paris are ahead, helped by anniversary dates and things like that. But basically, they're seeing improvements week on week. They did also highlight the fact that although at the end of the quarter all parks and ships are now open, Shanghai specifically was only open for 3 days within the quarter, so obviously that's going to have some impact. They also highlighted smarter capacity management, was how they called it, which was basically driving improvements in yield and efficiency. So ultimately, they're having more elasticity in their pricing. They're sort of deliberately managing capacity to, again, kind of improve that experience, which apparently is also really working. They also highlighted the fact that they're building more immersive rides at the moment. One's already been built, which was the Guardians of the Galaxy, and they're also building 3 new cruise ships to add to their 4. One of them basically has just launched, which is called Wish, and I mean, I actually had a look on it, and some of their other ships are maybe starting to look just a little bit dated, not like really old. Cruise ships do have many decades of lifespan, but the new ship is really beautiful and very impressive. And I speak as somebody who actually enjoys cruising, been doing it for many years. Not been on a Disney cruise, in fairness, but I do now have a young daughter, so who knows what the future holds. But it's a really beautiful looking ship, and evidently capacity and demand for that new ship especially is super high. They did highlight specifically cruising as being the most impacted of all of their business segments. And you can see why. I think they do expect it to recover, but at the moment it's still the part that's lagging the most, maybe outside of their new ship. But overall here, I'm really encouraged specifically by parks. And I know a lot of commentators of Disney would have started with the streaming. And by the way, we absolutely will get to that in just a second, because it's also pretty impressive. But to me, I thought the parks was actually the most impressive part. And to me, like, when I think about the likes of Netflix compared to Disney in terms of their streaming offering, like, Disney just has the capacity to take their streaming subscribers and really monetize them much more heavily, right? Like, the example I like to use is Netflix's Queen's Gambit, right? I like chess, love chess actually. I enjoyed that program, but how does Netflix monetize off of the success of its content, right? It's really a struggle. Apparently chessboards went up, like sales went up. Who sells chessboards? Well, they go to Amazon, right? It's like chess lessons went up. Okay, who sells chess lessons? I don't even know. Fiverr, no idea. But it's like, it's difficult for Netflix to sort of take, when they do hit a home run in terms of their content, to monetize it. It kind of leaks into other areas. With Disney, right, like, I do have some concerns. If you look at the table here in terms of their cash flow, like income, yeah, okay, like net income specifically is growing, it's under pressure, but it's still growing. So that's pretty decent, and the margins are recovering, although I would say they're still quite low. But Disney at the moment is having to invest in content like everybody, but Disney is then presumably able to channel that into parks, right? It kind of creates that demand, and it sells more stuff, right? Merchandise is also included in the park section, by the way. So it's like, they have a real success with like Mandalorian, and then they can sell Baby Yoda toys, right? And that to me is like way more of a scalable, synergistic business model, and that to me is why I personally much prefer Disney to Netflix. Now, in terms of subscriptions or subscribers, I think first of all we have to be very careful. Like, a lot of commentators have been quite lazy in what they've said, that Disney now has more subscribers than Netflix. That isn't technically true. What they have is more subscriptions than Netflix, right? So like a subscription is a product. What you don't know is how many of the subscribers have multiple subscriptions, right? So do they have like Hulu and Disney, ESPN, etc.? So, and I suspect that figure is actually less than Netflix if you look at unique subscribers. Now, Disney on their earnings call actually got it right. They specifically said total subscriptions. So they have 220 million subscriptions, and the more than Netflix, that wasn't Disney. I kind of put that into speech marks because that's what a lot of commentary will say. Not technically true. So just be a little bit mindful there. I don't want to take away from what is a really good quarter. And I would say Disney growth is still way ahead of expectations by about 2 quarters, I think, compared to the numbers they want to get to by the end of 2024. So of the 221 million subscriptions, 152 of them are on Disney Plus. And they gained about 15.5 million subscriptions, of which just over 14 million were Disney, and 500,000 sort of scattered across sort of Hotstars, Hulu, ESPN, etc. So impressive, really. I thought this was quite an interesting comment, and I was surprised that none of the analysts really questioned it. In fairness with you, like, the analysts all got one question each, and I think they wanted to ask about 5. Disney were very efficient in their earnings call, I would say. I've seen earnings calls go over like an hour and a half, and Disney just weren't having any of it at all, kept it under an hour. So that was interesting. But one of the comments that Bob said was that Disney Plus is still a young business, and ultimately at the moment they're learning that when they launch a new franchise, that not only are they picking up like a new audience for that specific franchise, but then they're noticing that they're basically getting greater engagement into other franchises, so other programs, into parks, etc., which again kind of builds more into the synergistic machine. Like, I would have liked to have got some more information, some exact details. I also got the impression that as a combination of data into parks as well as data into streaming, that they're just getting smarter, understanding their audience, basically, which for me is a good sign. I always like businesses that are data driven, and kind of, you start to see how companies are using data to improve earnings and revenue. So it's a shame that no one asked further than that, but I thought it was an interesting comment. One of the other interesting things to call out was specifically Indian growth. They were very complimentary about, GDP, middle class, macroeconomic trends in India generally. They highlighted the fact that they had a particularly strong quarter in Hotstars, which was aided by the growth in, aided by the end of the Indian Cricket League, Premier League, but for cricket, end of seasons, which really helped. There is a very competitive broadcasting auction for those rights, and Disney has sort of like walked away from some of them as of 2027, I think it is. So they did kind of highlight the fact that at the moment, although they were increasing their subscription growth numbers projections for India, that it was quite likely to be updated once things clarified in terms of IPL rights. Again, cricket's a big sport in India for anyone not aware. The one other thing I would say is Hotstars doesn't bring in the same kind of ARPU, average revenue per user, that the likes of Disney Plus does. So it's not as important for their earnings particularly, but also their revenue, but just something to consider, and they wanted to call it out. In terms of the upcoming ad-supported features, so I think they penciled in December there with a $3 price difference. Now, they refused to be, they didn't want to be committed in terms of what the monetization per sub would be, how much it potentially would cannibalize existing sales, right, at a higher threshold. What they did say, and I kind of, would have been nice to get that, but I also think that there's considerable uncertainty with that as well. They were talking about learning off of Hulu, where they've had this feature for many years. They think especially it'll be very popular in kind of their 18 to 49 demographic. I suppose they're more price sensitive and don't actually mind adverts. As somebody who's in that demographic, smack bang in the middle almost, I actually don't mind adverts as long as the adverts are targeted, useful, interesting, good adverts. Ultimately, I'm kind of okay with paying less for my subscription and paying for adverts. I'm quite happy if advertisers want to pay for my subscription instead. So it was interesting that they were talking about that. But yeah, they do expect it to have some impact. They do still think that many people will be quite happy to not have the ad-supported feature, but they seemingly are quite confident about advertising demand. They're going to start with a small load, as they called it, and basically build from there. So I think we're not going to see kind of this balloon from day one. And I think we'll sort of see it grow and then I guess get smarter and learn from it. So we need to keep an eye on that and not panic or get too excited either way. So I guess to summarize, I haven't touched a ton on the details, but I think the numbers kind of speak for themselves. Their revenue up 26%. Again, revenue really led by parks and again, entertainment, media, merchandise sales and cruise lines are all included in that. Operating income definitely up. No dividend, and actually for me, I don't want Disney to pay a dividend at the moment. They mentioned it on the last quarter earnings call, and I'm glad they didn't mention it again. I want Disney to be investing in content and growing their Disney Plus, right? It's meant to become profitable in 2024. Great, as a standalone business, effectively. Right now, we do have a profitable business, but effectively, the profitable business is still recovering to some degree, and it's also subsidizing the growth of streaming. So I would say at the moment, when I look at Disney, although I am a lot more confident in it now, I think it's a screaming hold as a minimum. It does still seem quite expensive to me on a traditional value scale, right? You're probably looking at EPS for the year a little over $4, probably $4.10, $4.20, something like that would be my expectation. Shares now are $120, so you're looking at a PE of about 28. Which, that's like a Microsoft PE, and there's no way, I don't think any reasonable person would suggest that Disney is a better business than Microsoft from an investment perspective, right? Which is what you have to believe to kind of justify that PE. However, of course, in fairness to Disney, and, a couple of people challenged me in Discord when I mentioned this as well, Disney themselves aren't really focusing on the earnings today, right? Their whole business model is to achieve scale, to grow, to expand. They're now in over 155 countries in terms of streaming. That this is a business that in many ways still feels like it's growing. They also highlighted lots of nominations for both their content as well as their news and documentaries. So, literally hundreds of nominations and something that ultimately feeds into this synergy machine. So, maybe I'm being a little bit unfair, but I would say the PE that you're getting today is an expensive PE. So you have to be confident that, over the next couple of years plus, that they're gonna deliver on these numbers. But for me, I would say that I am more confident that they are going to deliver on these numbers now. There's still a lot of recovery to do, but I think, you know, the per capita improvements as well as the subscription counts are really impressive. So I think that's my caveat. Basically, it's impacting cash flow. That's going to cause some demand for some time. But again, almost to be expected. And yeah, as long as you believe that over the next few years, Disney will achieve that scale and become a more profitable business, you can still make that argument. But, you know, you have to be prepared to really hold this for a few years and kind of ride any sort of quarter-on-quarter variance, which is sort of how the market's responding at the moment. So that would be my takeaway from Disney. Broadly speaking, though, I'd rate this as like a B+ to an A-. Like the more I heard on the earnings, the more I digested the numbers, the more impressed I was. Couple of caveats, sure, they have a little bit of debt as well. Not a huge amount, though, for a company of their size. They will have to invest in content creation, which will cause a drag for the next couple of years. But again, like you can't doubt the mouse. They're building a really impressive business. And like I said, I've had my confidence restored. So that's everything I have, my thoughts for Disney at the moment. Any questions, comments, etc. on Disney or anything else I've spoken about below. Otherwise, thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.